noticed how, sometimes a part of the economy you don't really think about that often just suddenly bursts into action?
Yeah.
Well, that's been happening recently with the gold loan market in India.
Oh, interesting.
So picture this, right? Gold prices in 2024, they shot up like crazy.
Oh,
A full 32% increase.
that's a huge jump.
It is, and it got a lot of people thinking, hey, maybe I should borrow against my gold.
Makes sense.
And that's exactly what happened. By January of 2025, the total value of all those gold loans had reached a mind-boggling Rs 1.78 lakh crore.
I can't even imagine.
It's a 76.9% increase compared to the year before.
That's almost like everyone suddenly remembered they had these gold assets just sitting there.
Yeah, kind of everyone realized the potential of what was just, hidden away in their lockers.
Right,
Yep.
right. And that 76.9% surge, it really it tells us something, doesn't it? It's not just that gold became more valuable to use as collateral.
Mm.
It also shows how many people actually rely on this kind of borrowing to meet their immediate needs. I mean,
Yeah.
that many people turning to gold loans.
Wrong.
It shows that, having accessible ways to get financing is really important for a lot of folks.
Absolutely. And that actually brings us to the main topic we want to dive into today. So on April 8th, 2025, the RBI, the Reserve Bank of India, decided, okay, it's time for some new rules for this gold loan sector that's, been growing so fast.
I see.
And the market, it reacted almost instantly. The very next day on April 9th, the stock prices for those big companies that deal with gold loans like Muthoot Finance, IFL Finance, Manappuram Finance, even Federal Bank, they all dropped significantly.
Oh, wow.
It was a pretty clear sign that these new regulations, they're a big deal.
Yeah, yeah. That kind of immediate reaction, it shows just how seriously investors are taking the RBI stepping in.
Yeah.
They must be expecting that these new rules are going to, have a real impact on how much these lending companies can grow and how profitable they'll be in the future. It's like
Right.
a sign that gold financing is about to change in a pretty fundamental way.
Exactly. So in this deep dive, that's what we're going to unpack. What are these new rules about? Why did the RBI decide to get involved right now after this, boom in gold loans? And most importantly, what could this mean for you, the listener, whether you've, thought about getting a gold loan yourself or you're just curious about the forces shaping our economy? We want to shed some light on what might seem like a really complicated situation.
When you see something become as popular as gold loans have recently, it makes you wonder what made them so attractive in the first place. And not just for people borrowing money, but also for the lenders. It was like a win-win for both sides.
Exactly. Let's take a closer look at this gold rush phenomenon, so to speak. Like we said, the biggest factor was that dramatic rise in gold prices back in 2024. When the value of your gold goes up by almost a third in just 1 year, suddenly that jewelry box starts looking a lot more like cash you could use.
Right, and for people borrowing, it's not just the higher value of their gold that's appealing. Gold loans are like super fast when it comes to getting cash. Unlike regular loans where you have all this paperwork and credit checks, you can just walk into a place with your gold and walk out with money, often in a very short time. It's leveraging something you already own to meet those immediate needs for cash.
Think of it this way. It's like trading in something you own for what you need right now, but instead of selling it completely, you're just, temporarily using its value.
Yeah.
And for a lot of people who might not have a perfect credit history or maybe don't have easy access to banks, gold loans, they become a lifeline to get the funds they need.
And for lenders, that huge increase in demand for gold loans, it was a big opportunity for them to grow their portfolios.
Mm.
With gold prices going up, the risk of lending against it seemed, well, manageable.
Right.
And the sheer volume of loans they were giving out, it translated into some serious profits. It was a time of really fast expansion for a lot of the companies in this sector.
But, and this happens a lot, fast growth in any part of the economy, it tends to attract attention from, regulators.
Mm.
So let's get to the heart of this. The RBI's intervention. What were the main reasons they decided to introduce these new rules now?
Well, I think the RBI was probably looking at how incredibly fast the gold loan market was growing, and then also factoring in how unpredictable gold prices can be.
Right.
While that 32% increase in 2024 was, good for business in the short term, that kind of rapid increase, it's rarely sustainable. And the RBI was probably thinking, what happens if that trend suddenly reverses?
Yeah, exactly. And this is where the idea of loan to value, what we call LTV, becomes really important. The RBI currently has this rule that says lenders can only give you a loan for up to 75% of what your pledged gold is worth. That 25% difference, it acts like a safety cushion if gold prices happen to drop.
Right, but even with that 75% limit, if gold prices were to drop significantly, that cushion could disappear pretty quickly. Let's say you borrow, RS 75,000 against gold that's worth RS 1 lakh. If gold prices suddenly go down by 25%, well, your gold is now only worth RS 75,000. That safety net is gone, and if prices keep dropping, the lender might not be able to get back all the money they loaned out.
And that brings up another potential problem: borrowers defaulting on their loans. If someone takes out a gold loan thinking gold prices are going to stay high and then suddenly they plummet, it could become much harder for them to pay back what they owe.
Exactly.
Yeah.
Especially if what they owe starts getting close to, or even more than, what their gold is worth. And if borrowers do default, lenders usually can auction off the pledged gold to try and make up for their losses. But if gold prices have really tanked, what they get from the option might not be enough to cover the loan and the costs of the auction itself.
So it sounds like the RBI is kind of trying to get ahead of things.
Yeah.
They want to make sure this growth in gold loans is sustainable and doesn't create bigger problems down the road. It's like they're saying, let's not wait for things to go bad before we take action.
I think that's a great way to put it. It's all about managing risk for the entire financial system. With so much money tied up in gold loans, almost RS 1.78 lakh crore like we mentioned, any big problems in this sector, they could have a ripple effect on, the entire economy. The RBI is, they're trying to protect against that.
And the market definitely reacted strongly to this news. We
Right.
talked about how stock prices for those big gold loan companies took a hit on April 9th. Could you remind us what those drops looked like specifically?
Sure. So Muthoot Finance, they had a pretty significant drop of 10.15%. Manappuram Finance, their drop was a bit smaller, 2.8%.
Mhm.
IIFL Finance, they fell by 6.12%. And even Federal Bank, which, they do more than just gold loans, they saw a dip of 1.17%.
Those are, pretty noticeable changes, especially for Muthoot Finance. What do you think was behind this negative reaction from investors?
I think investors are mainly worried about how profitable these companies will be in the future and how much they'll be able to grow with these new regulations in place. They're probably expecting, lower lending volumes, higher costs to comply with the new rules, and maybe even smaller profit margins. It seems like the days of, really fast and relatively unregulated growth in gold loans, they might be coming to an end.
And the RBI's statement that came out with the announcement, it also seemed to hint at some underlying issues, right? They talked about harmonizing regulations and addressing observed concerns. That seems to suggest they've maybe seen some things happening in the industry that they're not so happy about.
Oh, absolutely. The way regulatory bodies like the RBI use language, it's often very deliberate. When they say things like harmonizing regulations, they usually mean they want to make sure different types of financial institutions like banks and those non-banking financial companies are all following the same rules when it comes to, a certain type of lending. And when they mention observed concerns, it strongly suggests that they've seen some things happening in the gold loan market that they think are problems, and they're trying to fix those problems with these new regulations. So investors, they would naturally see this as, a sign that things might get tougher for some of these companies and their current ways of doing business.
So for anyone listening who maybe isn't totally familiar with how a gold loan works, let's take a quick break from all this regulatory talk and go over the basics. Can you walk us through like a typical gold loan, how it works?
Sure. So usually a borrower will take their gold jewelry or other gold items to a bank or one of those non-banking financial companies that offer gold loans. The lender will look at the gold, check how pure it is, how much it weighs, and use that to figure out its current market value. Then, based on that value and the RBI's LTB rule, that 75% limit we talked about, they'll offer a loan amount.
So if like your gold is appraised at, let's say, Rs 1 lakh, the most you could borrow would be Rs 75,000.
Exactly. Once you agree on the loan amount, the borrower pledges their gold as like a guarantee, and the lender gives them the money, often very quickly. The borrower then pays interest on that money for a certain amount of time, and once they pay back the full loan amount plus all the interest, they get their gold back.
And like we've been saying, how fast and easy it is to get these loans, that's a big plus for a lot of people, right? There's less paperwork, and the approval process is much quicker compared to a lot of other loans.
Right. For a lot of people, especially those who need cash right away or who don't have easy access to banks, the speed and simplicity of gold loans, it's a huge advantage. But it's super important for anyone thinking about getting a gold loan to remember there are risks involved. The biggest one is that you could lose your gold if you're not able to pay back the loan.
And on the lender's side, while the process might seem pretty simple, the main risk, like we talked about, is if gold prices suddenly drop.
Yeah, that's their biggest vulnerability. Which brings us back to, trying to understand exactly what the RBI's new regulations will be. While they haven't released all the details yet, we can make some guesses based on what they've said they want to achieve.
They've mentioned prudential norms and conduct-related aspects. What can we get from that kind of language?
Prudential norms, they're basically rules that are meant to make sure lending institutions are financially healthy and stable. When it comes to gold loans, this could mean stricter rules about how much capital lenders need to have compared to the amount of gold loans they've given out.
Okay.
It could also affect how they assess the quality of their loans and how they manage risk overall. With this sector growing so quickly, the RBI probably wants to be sure that lenders have enough safeguards in place to, absorb potential losses.
And conduct-related aspects. That sounds like it's more about how lenders actually deal with their customers.
Exactly. This suggests they're going to be looking at fairness and transparency in the way lenders do business. Could mean things like making sure borrowers understand all the terms and conditions of their loans, setting clear ethical standards for how gold is valued and how auctions are conducted if someone defaults, and putting measures in place to prevent unfair or, predatory lending practices. The RBI also talked about creating a level playing field for different types of lenders. That suggests they want to make sure banks and non-banking financial companies are, handling gold loans in a similar way, and that there aren't any inconsistencies in how they operate.
The RBI also used the phrase managing risk-taking capabilities. That makes it sound like they're worried some lenders might have gotten a bit, too aggressive in trying to grow their gold loan business.
Yeah, that's a very reasonable interpretation. All this rapid expansion, it might have led some lenders to, maybe loosen their standards a bit or take on more risk than they can handle in the long run. The RBI wants to be sure that lenders aren't, just assuming gold prices will keep going up,
Yeah.
and that they're still carefully evaluating whether borrowers can actually repay their loans, even though those loans are backed by gold.
And we can't really talk about gold loans without talking about what's been driving so much of this, the price of gold itself. That 32% jump in 2024, it really set the stage for everything we're talking about, right? Oh, absolutely. When gold prices go up, it fuels both borrowing and lending in this market. People who want to borrow, they see that they can get more money against their gold. Lenders, they feel more secure because the value of the collateral is going up. It creates a kind of feedback loop when prices are rising.
But like we've already said, this can be a bit of a double-edged sword. What if those prices start going down? How much protection does that 75% LTV cap really offer if there's a big drop in gold prices?
That 75% cap, it's definitely a key measure for managing risk. It gives lenders a 25% buffer in case gold prices go down before the loan amount reaches the value of the gold.
Right.
But how well that buffer actually works depends on how much prices drop and how quickly it happens. A really sudden and large drop, it could still wipe out that cushion, and lenders could end up losing money if borrowers default.
And I'd imagine that in this new, more regulated environment, lenders are going to be more careful about giving out loans, even if they stay within that 75% LTV limit. Yeah, that's very likely. With more scrutiny from the RBI and potentially stricter rules about how much capital they need to have, lenders might be pickier about who they lend to, maybe focusing on borrowers with good track records of repaying their loans, or maybe offering loans for less than that maximum 75% just to, reduce their own risk.
So let's think about who might benefit from these new rules and who might face some challenges. How could these changes affect different groups of people?
Well, for borrowers, there's a chance things could get better. Stricter rules about how lenders operate, that could lead to, more fairness and transparency.
Okay.
Things like how lenders explain the terms of the loans, how they handle defaults, how they auction off gold if they need to. Higher ethical standards could really offer more protection for borrowers. We might even see more competition among lenders, which could lead to lower interest rates.
And what about the lenders themselves, especially those big players like Muthoot and Manappuram, who, they've been the leaders in this industry?
For those larger companies, they're probably going to see higher costs at first, just from having to, implement these new regulations and make sure they're following all the rules.
Makes sense.
The fast growth they've been enjoying, it might slow down as they, become more cautious about giving out loans. They might
Mm.
need to invest in new systems and training for their staff to meet the RBI's requirements. And smaller, non-banking financial companies, especially those that don't have as much financial backing or aren't as good at managing risk, they might have a tougher time adjusting to this stricter environment.
And what about investors? We saw that initial negative reaction in the stock market. Is that just a short-term thing, or could there be longer-term impacts for people who have money invested in these companies?
In the short term, I think investors are going to be cautious until they have a better idea of, what exactly these new regulations are going to look like and how they'll affect the profits of these gold loan companies.
Right.
But in the long term, if these regulations actually work and they make the gold loan sector more stable and less risky, it could actually be good for investors. A slower but more sustainable path for growth that might actually be preferable to the possibility of, instability in a market that's less regulated.
It sounds like the RBI is really thinking about the long-term health of the entire sector, even if it means things will be a bit different for the companies involved in the short term. So looking ahead, what are some of the main changes we can expect to see in the gold loan market?
I think we're definitely going to see lenders being much more careful when they evaluate loan applications. They'll be checking more thoroughly to make sure the borrower actually owns the gold they're pledging.
Hmm.
It's also possible they'll start asking more questions about why the borrower needs the loan. And we might also see more monitoring of, how the borrowed money is actually being used.
And that 75% LTV cap, that seems like it's going to stay in place, at least for now.
Yeah, the 75% cap, that seems to be one of the main tools the RBI is using to, keep risk under control in this sector. While the cap itself might not change much, we could see changes to other rules, like the ones about how much interest lenders can charge or the procedures for auctioning off gold when a loan isn't repaid.
So for anyone out there who's thinking about getting a gold loan in the future, it sounds like they should be prepared for things to be a little bit different. There might be a little more scrutiny, and the whole process might not be quite as fast as it used to be.
Yeah, that's a good point. Borrowers might have to provide more documentation to prove they own the gold, and lenders might ask more questions about why they need the loan. The whole process could become a bit less streamlined.
And at the end of the day, how the gold loan market does in the future, it's still going to be tied to what happens with gold prices themselves, right?
Absolutely. The price of gold is the fundamental driver of both the demand for gold loans and the level of risk involved. Any big changes in the global economy or in how investors feel about gold, those things will continue to have a huge impact on this sector, no matter what new regulations are put in place.
It's really clear that gold loans, they're a big part of the financial system in India. They provide a really important source of credit for a lot of people. And with these new regulations, it seems like we're entering a new chapter.
I agree. It's a sign that the sector is maturing, that there's going to be more oversight and things will be more standardized.
Mhm.
And ultimately, the goal is to protect everyone involved, both borrowers and lenders, and to make sure the financial system as a whole stays stable.
This whole situation, it really makes you think about some bigger economic trends that go beyond just the gold loan market itself, doesn't it?
Absolutely. This big increase in gold loans, it really shows that there's a continued need for ways to access credit that are, relatively easy to use and available to everyone.
Right.
We're talking about farmers, small business owners, people who maybe don't have easy access to traditional banking services. The fact that so many people turn to gold loans to get money, it highlights some fundamental needs and limitations within the economy.
And the RBI's actions, they're part of their broader responsibility to keep the financial system stable and prevent too much risk from building up in any one area. This isn't just about gold loans, it's about making sure the entire economy stays healthy.
Exactly. We've seen this kind of thing before where the value of an asset goes up really quickly, or there's a lot of lending happening in a specific area. Gold has a long and important history as a store of value in India. But any market that's growing this fast, regulators need to watch it carefully to prevent bubbles from forming or, unsustainable lending practices that could end up hurting the whole economy.
So to sum it all up, The RBI is tightening the rules for gold loans in India because we've seen this period of really fast growth fueled by those rising gold prices. They want to make things more stable and reduce the risk for the entire financial system. This move has already had an impact on those big gold loan companies, and it's going to change how these loans are offered and managed. That could mean changes for both lenders and borrowers.
And it's really important to remember that all of this is happening in a country where gold has a really deep cultural and financial significance. It's something people value and cherish, but it's also a way for a lot of people to access credit quickly.
And that leads us to our final thought for you today. Given how important gold is in India, both culturally and financially, and the fact that it's both a valuable asset and a way for people to get the money they need quickly, how do you think these new regulations, which are meant to make the financial system more stable, will ultimately shape how individuals make financial decisions and how the overall lending landscape will look in the years to come? It's a really interesting intersection of tradition, economics, and regulation. And how all of that plays out, well, that's something we'll all be watching closely.
Yeah, definitely something to keep an eye on.
Thanks for joining us.
It was my pleasure.
We'll see you next time.
See you then.